Two people, same company, same take home. One of them pays 50 cents on every dollar in taxes. The other pays closer to 20. Same currency, same country, same tax year. The tax code just treats their $2 completely differently. What separates those two people isn't income. It isn't effort. It isn't intelligence. It's a single pivot most high earners never make. And if you're holding pre-IPO equity right now, you're standing directly on top of it without knowing it. This video is the framework that determines whether your equity ever turns into actual sustainable wealth. 3 levels, 1 pivot, the structural map underneath every pre-IPO planning decision you'll ever make. Here's the part nobody taught you when you signed your offer letter. There are 2 economies inside the United States tax code. Same country, same IRS, same Form 1040, but 2 completely different sets of rules. The tax code on this side is, in most cases, unforgiving. At the top federal bracket, ordinary income is taxed at 37%. Add California state tax, which tops out at 13.3%. Add Medicare, add the net investment income tax when it applies, and for a high earner in California, the combined top marginal rate on ordinary income in most cases lands above 50 cents on the dollar. That is a fact about the code. Your specific situation will vary, but the structure of the code itself is what it is. Top marginal rate in California can exceed 50%. Now we're going to dive into the second economy. The investor economy, long-term capital gains, qualified dividends, the income generated by assets you already own, held for the right amount of time, classified the right way. On this side of the code, the top federal rate is 20%. Add the 3.8% net investment income tax, add California state tax, which for most high earners applies ordinary rates to capital gains. The combined top rate on this side lands roughly in the low to mid 30s, depending on your specific situation and state of residence. Sit with those 2 numbers for a second. On the worker side, the code in most cases can take more than half. On the investor side, on the same dollar, the code in most cases takes about a third. The difference, depending on your specific situation, is somewhere between 15 and 25 percentage points per dollar every year. So I'm going to reframe those numbers in a way that might land harder. So convert those percentages into your calendar. A 50% tax rate in most cases is 6 months out of the year. 6 months of your commute, 6 months of your meetings, 6 months of your calendar is going to the tax code before any of it reaches your bank account. I mean, that has to be some kind of sick joke. A 33% tax rate is closer to 4 months. The structural gap between these 2 sides, depending on your specific situation, can mean roughly 2 extra months of every working year that on one side you build your wealth and on the other side you don't. And over a 20-year career, that's roughly 40 months of your calendar, more than 3 full years. And the pivot from going from worker to investor is what decides whether those 3 years work for you or work for the tax code. The tax code is not punishing workers. I want to be very clear on that. The code is a set of incentives, and it rewards certain behaviors. Holding assets for 12 months or more, generating income from ownership rather than labor, and deferring gains until they qualify for long-term tax treatment. When you behave like an investor, the tax code treats you like one. When you behave like a worker, the tax code does the same. Most high earners never move from one side of the code to the other. They earn more, they get taxed harder. They earn even more, they get taxed harder still. They are consumers of money, not producers of it. Their lifestyle expands to match their income, and they never cross what I call the pivot. This is the entire game. Everything to the left of this line funds your life, and everything to the right of it builds your freedom. So if the pivot is this obvious, how come everybody doesn't make it? There are 3 reasons, and all 3 apply in this example to pre-IPO shareholders. Reason 1, income feels like progress. A bigger paycheck, a bigger bonus, a bigger RSU vest, all of it feels like forward motion. And for a while, it is. But if every additional dollar of income flows through the worker side of the code, then every raise is taxed at, in most cases, your highest marginal rate. You are effectively getting a smaller share of each subsequent dollar. Many people I sit down with have doubled their income over 5 years and haven't doubled their asset base, because the second $100,000 of income in most cases is taxed more aggressively than the first. And the truth is, because of lifestyle spend and FOMO, the spending tends to rise in lockstep with after-tax pay. If you're at SpaceX, Anthropic, Anduril, Databricks, or Stripe right now, and you open your equity portal, the number you see is in some cases multi-million-dollar figures. It feels like you've already already crossed the pivot. But that number is still 100% on the worker side of the code, unrealized, undeployed, and locked inside a single concentrated position. The IPO doesn't automatically move that number across the pivot. The IPO creates the opportunity to move it. The deployment decision is what actually does it. I've sat across the table from shareholders who walked into a tender offer with a 7-figure equity position and walked out of the IPO year with, in most cases, less wealth than they expected. Not because the stock underperformed, because the proceeds flowed right back into level 1 spending instead of being deployed across the pivot. The wealth was generated, it just wasn't captured. And I know what some of you are thinking. The squeeze looks expensive. Exercise ISOs now and you owe AMT in April. Sell at the tender and you owe capital gains. Build out a diversified portfolio and you're making decisions instead of just letting your equity ride. So you have to ask a simple question. Is this juice worth the squeeze? The squeeze is the short-term tax cost, the hassle of staging exercises across multiple tax years, the paperwork, the discipline to redirect proceeds into level 2 instead of letting them fund a bigger lifestyle. The juice, depending on your specific situation, is potentially decades of investor side compounding on the lower tax side of the code. The roughly 2 extra months of every working year we talked about earlier for the rest of your financial life. Most of the shareholders I work with, once they see both sides of that trade clearly laid out, conclude the juice is absolutely worth the squeeze. But it is a decision you should make with real numbers and your complete financial situation in front of you, not based on what side feels easier at the moment. Reason 3, the window closes before you notice. Pre-IPO shareholders operate on a timeline they often don't control. Blackout periods restrict when you can exercise. Tender offers open and close on the company schedule. An IPO is followed by a lockup, typically 180 days, where you still can't sell. For many shareholders, that 8 to 12 month window is where that pivot could be made. If it passes, it's no longer available. If your plan is I'll deploy after the IPO, you need to look at the calendar and ask yourself whether after the IPO actually has a date on it. Because for most shareholders right now, the earliest realistic public liquidity is roughly a year or more out. That is a long time to stand on one side of the pivot, paying worker side taxes on every vest without being able to move anything. So here is the framework, the full structural map. This is what sits underneath every piece of planning we do at Augustus Wealth. We call it worker to investor. 3 levels, 1 pivot. For a pre-IPO shareholder, level 1 includes your base salary, your RSU vest, your NSO exercise spread, and in most cases, any ordinary income recognized through an ISO disqualified position. All of it is worker side. The pivot is the savings. That's it. That's the entire mechanism. The dollars you don't spend are the dollars that can cross over to the investor side of the code. Savings is the only input level 2 accepts. I want to be honest with you here. Savings is not glamorous. It's the stock going up. It's not the tender offer check hitting your account. It's the boring, unsexy decision to take a portion of each dollar that hit your bank account and send it across the pivot instead of into your lifestyle. And for most of my clients, this is the hardest part of the framework. Not because they can't do it, because it doesn't feel like progress, and we're wired to chase progress. Level 2 is where the savings becomes an asset. Diversified portfolios, index funds, direct index accounts for tax efficiency, fixed income, real estate in some cases, retirement accounts being maxed, including 401k, backdoor Roth, and mega backdoor Roth where your plan allows. HSA contributions invested rather than spent. This is the middle of the map. It's the construction phase, and you're building the machine that will eventually produce the investor side income. Level 2 for a pre-IPO shareholder looks like this. So proceeds from a tender offer carefully staged for tax efficiency, deployed into a diversified portfolio, and the post-IPO sales are structured to qualify for long-term capital gains treatment where possible, and they're funneled into the same wealth building account. Retirement accounts are filled to the legal maximum every year or close to it, and emergency reserves are held in high yield cash to carry you through the low liquidity zone without forced selling. Level 3 is where assets produce income on their own without your time. Qualified dividends, long-term capital gains from rebalancing, interest from fixed income, which is still worker side taxed, but embedded in a portfolio where the overall tax profile is dominated by the investor side. In some cases, there is real estate cash flow. In some cases, business income from an ownership position outside your company stock. At the level 3 side, your portfolio is working for you on the low side of the tax code. And because the assets themselves are productive, you have what the framework calls leverage, not debt leverage, optionality leverage, and the ability to stop working, change jobs, take a sabbatical, start a company, or make a decision that isn't dictated by next quarter's vest. Level 1, pivot at savings. Level 2, level 3, that's the map. So every pre-IPO planning decision you'll ever make lives somewhere on this map. Tender offer timing, that's whether or not you fund level 2 while the door is still open. The AMT crossover strategy, that's minimizing the tax of getting your ISOs across the pivot efficiently. Concentrated risk, that's how much of your net worth is still trapped in level 1. And post-IPO sell schedules, that's the mechanism that moves equity across the pivot on a deliberate cadence instead of an emotional one. It's all the same map. Here is the single sentence I want you to carry out of this video. Equity makes you a worker. This framework makes you an investor. If you want to see where you currently sit on this map, head to augustuswealth.com. The concentration risk analyzer tells you how dependent your wealth is on level 1. Critical mass simulator shows you the level 3 number where your portfolio sustains your lifestyle on the investor side of the code, and the ISO calculator helps you model the tax cost of moving equity across the pivot. No login, no email gate, just the math. This video is educational. It's not personalized tax or investment advice. Your complete financial situation requires its own analysis. And the numbers I cited today reflect the structure of the tax code, not a prediction of what you'll personally pay. Talk to a professional that can look at your full picture.